I'm Mills. Let me share a little about how I got here. I started my financial journey fall of 2014 when I found myself with only $1.50 to my name. So clearly, I understand the frustration around money mismanagement, struggling with where to start, and the courage it takes to take ownership of your finances. Now I'm a financial coach, speaker, author, and the founder and owner of Mills Knows Bills, where I have the opportunity to teach individuals and businesses how to manage and master their money within 90 days. On this podcast, I will teach you how to stop living paycheck to paycheck, how to pay off your debt twice as fast, and how to reach your financial goals. This podcast is meant to make managing your finances accessible. So if you find that your finances are controlling you, or you simply have no idea where to start, this is the place for you. Click the subscribe button and turn on your notifications to make sure you don't miss out on any new content. I appreciate you tuning in. Let's dive into today's topic. All right. Thank you for taking time out of your day to learn more about the perfect investment. This is a conversation that Corey and I have talked about a few times, and I'll give him a brief introduction and then I'll let him take the floor. So I actually met Corey through BNI, which is a networking group, and he's actually in Texas. We started talking about finance and investments and just kind of hit it off. And I thought he would be the perfect person to talk to you all about the perfect investment. So Corey, why don't you go ahead, introduce yourself, talk a little bit about what you do and why.
Well, great. Thank you so much for having me. First off, like Mill said, we did meet in BNI, but that was before COVID even happened. This has been a process in the making. We've stuck together for a little while, and I'm really excited that it's finally happening, that I can actually come. And so, like she said, I am a financial advisor in Texas, specifically Tyler, Texas. It's a relatively small town in deep East Texas. I am married to my high school sweetheart, Kinsey, and we have two beautiful little babies. So I graduated from Baylor University in Waco, Texas, and actually was going to go a completely different direction with my career. I was really big into physical fitness, sports. So I thought, what's the next best thing if I can't become a professional athlete? And that was physical therapy. So I started my career as a healthcare worker in a hospital, and really just learned that over the years that my brain was more adapt to the financial world, as well as just the lifestyle of the difference between hospitals and being my own financial advisor, kind of being my own boss. So that's when I made the switch. It was back in 2018. So I have been a financial advisor for a little over 3 years now. I really just truly love helping people trying to figure out the puzzle pieces to everybody's life of how do we navigate the financial waters? How do we save for multiple goals? How do we accomplish that? A lot of times the big questions I get are, how much do I need to save? How much do I need to have? And how much can I spend? Well, that's where I come in, and I get to help solve those problems and take a lot of the burden off of my clients and put those on my shoulders. That way they can live a little bit of a less stress-free life.
I love it. And thank you for sharing your background. I think that allows other people to see that, it doesn't matter your background. You can have the financially strong life that you have always wanted. Corey, whenever you are ready to get started. All
righty. Well, like Mill said, today we are going to talk about the quote unquote perfect investment. This is, like I said, I'm with Edward Jones, which is just a financial institution, and I am the financial advisor. My job is to, again, come alongside everyday investors and help them reach their long-term financial goals, whether it be living or saving for or living through their ideal retirement, saving for a loved one's education, leaving some sort of legacy to friends, family, or charity, or even efficiently passing assets down to children and navigating the estate process. So this is a comment that I hear quite a bit of why people don't want to invest. There's a multitude of reasons why people don't want to invest. But this is a big one of it's my money. I've worked hard for it. I'm just waiting to find the perfect investment. And I hate to tell you, but there is no such thing as one perfect investment. The way that investments work is they typically fall into one of these categories. And there is some overlap, but for the most part, each investment falls into its own category. So everybody wants their money to grow. Everybody wants their money to be accessible to them, meaning they want to be able to spend their money. They never want their portfolio or their value of their money to go down. And they also want it to produce some sort of income later in retirement or for whatever goal that they're looking for. So we'll go through each one of these little sections and talk about what investment falls under these and how to tie everything together to create a portfolio that can accomplish all four of these things without having all your money or all your eggs in one basket. So we'll talk about growth first. That's kind of the fun one that everybody wants to talk about is everybody wants their money to grow. So typically what falls under growth investments is small cap stocks, mid cap stocks, and mutual funds and ETFs. And so a small cap stock, if those of y'all who do not know, a small cap stock is a small company, like the name implies, with its market capitalization under $300,000 of market capitalization. And all market capitalization is taking the amount of stocks that the company has offered and what the price is going for. So if you multiply those two things on a company and it's less than $300,000, it's considered a small cap stock. These stocks are typically more volatile, meaning they will go up really high in value and drop. So you'll see bigger swings in the value. And some people can't stomach those big swings. So our mid-cap stocks, these are companies that are a little bit bigger than small cap stocks. They may or may not be paying any sort of dividend, and they have a market capitalization of between 2 billion and 10 billion. So there's a pretty big spectrum there. But anything that falls in that gap is considered a mid-cap stock. So these are, companies like Dick's Sporting Good, Energizer. So it's companies you still heard of, but they're not as grandiose as some of the other household names that you know. So mutual funds and ETFs. So all a mutual fund is a group of stocks that what's called a money manager has pre-bundled. And instead of you saying, I want $1,000 worth of Energizer stock, or I want $1,000 worth of X stock, I'll give you $1,000 and you spread out my $1,000 within that mutual fund, however the money manager sees fit. And it's already predetermined. So the benefit of having a mutual fund is it's actively managed, meaning that there's a money manager that's looking at that bundle of investments. And so let's say one, stock X is not performing well, but stock Y really is. Well, he'll remove stock X and put stock Y in there for you. That way you're not having to worry about it. So an ETF works pretty similar to a mutual fund in the fact that it's a pre-bundled investment, but it's not actively managed. It's what we call passively managed, meaning it doesn't have a money manager involved with it, and it really follows an index. So there's not a whole lot of buying and selling inside of it. It's going to do what those are going to do. So those are our growth investments. Those are things that pull the boat forward that people like to own because they make their portfolio go up. So with stocks and mutual funds, they're not as liquid as cash and money markets. So with a stock, it sells when you place a trade. But if the market is down, then you're going to get a lower amount than maybe what you paid for it. But you also have to wait for that stock to trade. You have to go to your broker. You have to go online. It's not liquid cash or liquid assets. You can't go to the store and buy a jug of milk with a stock. So that's why it's not considered liquid. It's kind of liquid, but not fully, not as much as cash in money market. So cash is just cash that you have at the bank, cash that you have buried in your backyard, in your wallet, hidden under the bed, whatever it is. It's easy cash that you can hold. You can go buy gas, milk, whatever you want to buy with it. And then a money market. So a money market is still an investment, but the closest comparison is a savings account where it gives you a little bit more interest. So it actually is invested. It's invested into treasuries and things like that are paying interest, but it's still liquid. You're still able to get access to that relatively quickly. A lot of places I know you can transfer directly from a money market to a bank or to an institution if you were to say buying a house or something like that. So into our protect, this is a big one because nobody likes to see their value go down, especially when you're investing, especially when it goes down a lot. If anybody was paying attention back in March of last year, the market dropped close to 40%. Nobody liked that. So ways to protect your money or a portion of it is 1, annuities, 2, CDs, and then the third would be life insurance. So an annuity, essentially what it is you are giving, it's a life insurance product. So you're giving the life insurance company your money, and it's going to do one of two things. It's going to have some sort of floor, meaning protection, meaning it's never going to fall below, and it'll grow a little bit slower. So if you put $100,000 in, it'll never go below $100,000 unless you start pulling money out, and they'll, guarantee you, 1-2% growth. So you kind of have to pay for that floor so it never goes down. A CD, the reason why this is in a protection category is because it is FDIC insured, meaning if the bank that you own your CD at goes under, the government is backing that. There's some backing to that CD, so you will get your money back. Also, if you hold it to maturity, meaning if it's a 12-month CD and you hold it for 12 months, you will get your money back. You may see the value fluctuate but if you hold it for that contract, it is not going to go down and you're going to get some sort of interest. And then life insurance, obviously, is if you're making plans for retirement, if you're making plans for education, whatever it may be, and you pass away, well, this protects your family that they can still achieve those goals. So same thing kind of with an annuity is if you're building some sort of cash value, the death benefit, unless you start pulling off of it, that death benefit's never going to drop below what you bought. And you may even get some sort of cash value on top of it. But as long as you are paying for that policy and it's in force, and if you pass away, you're getting the death benefit that you paid for, unless you're starting to pull withdrawals off of it or pull money off of it. And then the last one is income. So these are investments that really produce income. So it pays you either some sort of interest or dividend. And really the difference between an interest and a dividend is an interest is money that comes from what's called a fixed income investment, a bond, money market, CDs. A dividend is what comes off of equity. So meaning stocks, mutual funds, things that are in the growth, kind of that growth category. So what's in the income is bond funds, and large cap stocks. So large cap stocks are anything that are above $10 billion of market capitalization. So these are big companies that you know and love and probably use every day. Pfizer, AT&T, Apple, Amazon, those are your big, large cap companies. Those are companies that are paying you a dividend, meaning they're sharing in the profit for letting them use your money to grow their company. So bond, essentially what it is, it's typically a longer CD, but it's not backed by the government. It's not FDIC insured. So what a bond does is you say, I will let for example, I'll let Tyler, Texas or Miami, Florida, I will let the municipality use my money and they can use it for 5 years. But in 5 years, you're going to pay me some sort of interest, either semi-annually or annually. And then at the end of 5 years, you're going to give me my money back plus all my interest that I earned. So if you keep the money or you keep your money invested for that contract, you're going to get your money back. But in the meantime, it's paying you income. So the reason, again, why a CD doesn't fit in the income, it's more in the protection, is because of that FDIC protection, as well as some of these bonds could possibly default, meaning the person you lended your money to can't pay you back. So that's essentially what that means. And so using good quality bonds really kind of ensures that they don't default on that loan. So a bond fund is essentially it's a mutual fund, but it's made up of bonds. So just like a mutual fund is built up of stocks, a bond fund is built up of bonds. And that's really the only big difference there. So again, each of those investments fit into different categories, and you can see there's no one investment that covers everything. So there is some sort of overlap. So growth and income could be large cap stock. It's still, the value may continue, but it's still paying you dividends. Protection and income, a CD is a great example, or even an annuity. So an annuity, it's never going to go down unless you start pulling money. But once you start pulling money, it's creating income. Liquidity and protection, cash. Your cash value, the dollar, you have a dollar, you can go use that dollar. It's liquid, but it's not tied to the stock market. And then liquidity and growth would be just a simple stock. It has the potential to grow, and it's relatively liquid, but not as liquid as cash. So there's a little bit of overlap. So finding out what is most important to you will help guide you in what sort of investments you need to be invested in. So this is what I do as a financial advisor. To kind of be frank, the investing part's kind of the easy part. Anybody, any financial professional can, pull up the list of stocks in the S&P 500, close their eyes, throw a dart, and they'll make some sort of money. There's a good chance they'll make some sort of money off of that. Really guiding people through the financial waters and dealing with life is what a financial advisor is for, what I'm for. So what I do is I work with clients to develop different buckets. And you can see here, there's the immediate bucket, near term, long term, and legacy. So in the immediate bucket, I make sure that all my clients have an emergency fund set up. And this is liquid cash. So there's your liquidity. It's 3 to 6 months expenses, meaning if you were to lose your job, if you weren't able to work, you got injured, or God forbid, another COVID struck, you would have 3 to 6 months of expenses to live while you figured out what your next step was. So our near-term bucket, this is what we consider your backup to your near-term or to your immediate. So let's say you have a big medical expense and you go through your 3 to 6 months expenses. Well, this near-term bucket acts as a buffer between your emergency and your retirement plan or any other goals. This can be made up of bonds, dividend-paying companies. Really, it's probably your non-qualified accounts, meaning it's accounts outside of retirement. So not a 401k, not an IRA, typically just a normal brokerage account. Then we get into our long-term bucket, which this is really for retirement. So these go into 401k, IRAs. This one can be a little bit more growth oriented for most people because you typically have a longer time till retirement. And so you have more time to make up any declines in your portfolio. And then lastly, your legacy. So this is where we get into your estate plan and start talking about life insurance. Because if you don't have any sort of insurance or you don't have your will in place, everything that we did in those other 3 buckets is kind of a moot point. Because if you don't have life insurance and your spouse passes away, well, you may be eaten into your immediate and near term and maybe even your long term bucket a lot quicker than you were thinking because you just lost income. That may be another source of income, or family. That can be hard on families for losing someone. You have medical bills, final expenses. So making sure that all four of your buckets are taken care of can really relieve a lot of stress. And again, that's where I come in. I don't expect everybody to know, how to do each one of these, otherwise I probably wouldn't have a job. So that's where I come in, is come alongside you and figure out, what are your goals? Do you want to save for retirement? Do you want to save for education? Do you want to buy a house in a couple of years? Do you have a daughter that you need to pay for the wedding in a few years or a year? How do we do that? And how do we balance all four of these buckets? So that's how I help my clients, and that's how a financial advisor should be helping you. So that's kind of a brief rundown of just investments, kind of how they break down. If you find yourself asking yourself the question of, okay, I got to find that right investment, or I haven't found it yet, there's a good chance you're not going to find it. And by following these steps and using those four bubbles, you can take a lot of stress off of yourself and realize, okay, I need to expand my portfolio and become a little bit more diversified than I think I need to.
Corey, thank you so much for going through that presentation. I think everybody learned a lot, but what we're really hearing is that there is no one investment out there that covers all four categories: growth, income, protection, and liquidity. There's no unicorn investment out there, right? So how can someone find the perfect investment for them?
So step one is figuring out where you want to be. What is your goal? If your goal is, I want to start to establish my emergency fund, okay, well, let's start with 3 to 6 months expenses in a bank account, in your savings account. That's cash. That's your liquidity. If you say, you know what, I've got that taken care of, now I'm looking to build my wealth. Well, then we start looking at mutual funds and different types of stock investments. And again, by working with the financial advisor, you kind of figure out what your comfortability is with volatility in the market. Not everyone is comfortable with the same amount of fluctuation in their portfolio. Me being 27, I have a lot longer, hopefully, knock on wood, I have a lot longer lifespan. So I have more time to make up any sort of declines that I might see. And I'm pretty comfortable with investing. And so I can be a little bit more growth focused versus someone who's 75 years old in retirement. Well, they need that money. So they may not need to be as invested in growth investments. Maybe they need to be more invested into income. So that, I would say, step one is figure out what your goal is. Step two is figuring out where you are today.
Yes. I always say the same thing. You gotta have point A and point B, then you can figure out all the options to get there, right?
Right.
Based off of your response, it brings up two main topics that I would like to address. First one is risk tolerance, and the second one is asset allocation or diversification. So first, let's talk about risk tolerance, what that means, and how it's different for everybody.
Yeah, so risk tolerance is just essentially how comfortable you are with market fluctuations. So take yesterday, for example, take yesterday and today. So at one point yesterday, we were down 900 points on the Dow. Today, we were up 600. I think last time I looked, it was close to 600 points. That's a big swing. So not only did it go down 900, it went back up 600 in the span of essentially a day. Right. And if you can't handle that, or really that's what I do is figure out how comfortable you are with that. What's your response going to be? Are you going to say, you know what, this is part of the market, I'm going to ride it out? You may be, nope, I want to pull my money. This is horrifying. I don't want my portfolio to fluctuate as much as the market is. So that's what I mean by risk tolerance. And that's really a conversation that it's good to have with a financial advisor, or really even, have it with, a trusted partner or, friend, whoever, even your spouse. Really talk about how comfortable you are, with it. And, it's kind of gauge it on a scale of 1 to 10. And if you're 10, you're the most aggressive. If you're a 1, I'm burying cash in the backyard. So try to figure out where you are with that, and that'll help guide you in how much you're invested into each category.
Right. And risk tolerance is not a one size fits all. As Corey mentioned, It looks completely different for him than it does for me. And it's not something that is fixed. As your life changes and as you get closer to retirement, your risk tolerance will most likely change as well. So through asset allocation and diversification, Corey, how do you meet someone's risk tolerance? So first, let's talk about what diversification is. And then second, let's talk about how that relates to the risk tolerance.
Yeah. So diversification is really just don't have all your eggs in one basket. So instead of finding that one perfect investment that doesn't exist, that'll cover all 4 of those categories, let's break up our portfolio and prioritize. Give every dollar a purpose. Don't just say, oh, I want my money to grow. I'm going to invest it and it's going to grow. And there's no real purpose behind it. Again, that's why I say find out what your goals are. Find out where you want to be. So diversification is just a mix of investments between your goals. So you may have, like I said, in your emergency cash, your immediate bucket, you may have cash. In your near term, you may have some more conservative investments like bonds or large cap stocks, or even bond funds or large cap mutual funds. In your growth portion, maybe in your 401k, you have more of those growth stocks, small cap, mid cap companies. So you're diversifying so that when the market does go down, notice I said when, not if. So when the market does go down, the parts of your portfolio that you need the money the quickest don't fluctuate nearly as much. So as far as asset allocation, to kind of go on your second point, so what I do is figure out, what your time horizon is, how much time do we have until your goal, whether it be saving for a house, emergency fund, retirement, whatever it is, and how comfortable you are with volatility. Then we figure out how much we want in the front of the boat and how much we want on the back of the boat. Essentially, I'm like your captain. You're on a cruise ship. I'm your captain. You come up to me and say, I want to go from point A to point B. I ask you, how seasick do you get? How fast do you want to go? If you say, I am super seasick, I need to keep it as shallow as possible. Well, we keep it really shallow. We don't feel all those big waves. If you're a guy or girl that says, I'm okay with stomaching some of the big waves, I just want to get there as fast as I can. Well, we'll head for deeper waters and we may feel those bigger waves, but we may also get there faster because maybe we have a longer journey ahead of us. And so kind of a real world example, I'll use myself again as an example. So like I said, I'm 27. I'm pretty comfortable with volatility in my portfolio, kind of comes with the job. And so in my retirement account, I have about 80 to 85% of my portfolio into growth investments, meaning small, mid cap, large cap companies, mutual funds, ETFs, things that are growing, that are pulling the boat forward. About the other 15 to 20% is in fixed income investments. So bonds, bond funds, cash, CDs, things like that. Because when the market does fluctuate 40 points, well, I don't want mine to fluctuate quite that much, but I want the majority of my portfolio to be going forward. So again, looking at how much time you have versus how much or how comfortable you are with volatility really narrows down and helps me figure out what percentage you need in your growth investments versus your fixed income or your stability investments. So it can be, 50-50 split. You could be 65% into equity, into growth, and 35% into fixed income. It all depends on your goal and how comfortable you are with investing. And again, that just comes through conversations with your financial advisor or a trusted partner.
I love it. I love the analogy. I've actually never heard of the boat analogy before. I think that's fantastic. So just to summarize, risk tolerance looks different for everybody. based off of how much risk you want to be exposed to will depend on how your assets are allocated, how your portfolio is diversified across all of those 4 different categories. And again, because it's not a one size fits all, and because it depends on your goals and your personality, that's why you want to have a trusted professional help guide you in the right direction. And Corey is a great person to do that. So Corey, thank you so much for taking time out of your evening. I think everybody is walking away with a lot of value today. So thank you, thank you, thank you.
Yeah, absolutely. Thank you all so much for having me, and it was a great opportunity.
I'll see you all next time. Bye, Corey.
All right, bye.
Thank you so much for listening and allowing me to be part of your financial journey. As a thank you for tuning in, I'm offering you first access to special tools and information. Simply subscribe to my newsletter found on my website at millsknowsbills.com, where you can find my free budget setting tool, workshops, and so much more. You can also connect with me on social. I have Instagram, YouTube, TikTok, LinkedIn, Facebook, Twitter, and Pinterest. All links are available in the show notes. I appreciate you tuning in and spreading the love. Thank you for all the positive comments on social, and you know I love seeing your 5-star reviews as well. Always remember, mo money, no problems. I'll see you next time.